Your mortgage payment is about to go up. Grocery prices are still brutal, and now economists are throwing around the word recession. So let me ask you a simple question. How prepared are you, really, if Canada's economy tips over in 2026? Because here's the thing. Canada didn't fall into a recession in 2025, even though almost everyone said it would. But the risks haven't disappeared. They've just shifted. And if you don't know what it looks for you can easily get blindsided. Stay with me for the next 10 minutes of your life because I'm going to break down exactly what's happening, what the warning signs are, and what you specifically could actually do about it. Welcome back to KP Money Talks, and today's topic is very important for 2026 Canadians. And if you don't want to be caught off guard when the recession hits, hit that subscribe button and follow for the rest of the video. Let's actually start with some good news, because there is some good news. Canada survived 2025. The economy grew by about 1.7%. That's actually higher than most economists predicted after the US hit us with the tariffs. Think about that. Everyone said Canada was done, and yet jobs are added, household balance sheets are improved, and per capita GDP likely rose for the first time in 3 years. So the question is, why didn't we collapse? Well, it's for two big reasons. First, roughly 90% of our exports to the US were protected under the CUSMA trade agreement, meaning they were exempt from the worst of these reciprocal tariffs. Second, Canadian consumers kept spending. Consumer spending makes up about 60% of our entire GDP, and Canadians, stubborn as always, kept the number going. The Bank of Canada also cut interest rates aggressively from 5% all the way down to 2.25% since mid-2024. That gave breathing room to mortgage holders, businesses, and housing markets. So if 2025 was a test, Canada passed. Barely, but it passed. Now here's where it gets uncomfortable. Because dodging a recession in 2025 doesn't mean we're safe in 2026. In fact, there are 4 real risks that every Canadian needs to understand. Risk 1. The mortgage renewal cliff. Hundreds of thousands of Canadian homeowners are renewing their mortgage this year. And here's the scary part. Those renewing 5 years fixed mortgages are looking at monthly payments that are almost 20% higher when they were first signed. That's not a typo. 20% more. For a family already stretching thin, there's a massive hit of spending power. Risk 2. Household debt is out of control. Canada holds the highest household debt to income ratio in the entire G7. Canadians spend close to 9% of their disposable income just on interest payments alone, not paying down the actual debt. That itself leaves almost no cushion when things go wrong. Risk 3. The labor market is softening. Unemployment crept up to 6.7% earlier this year. Young workers and newcomers are being hit the hardest. Employment growth is slowing, and while some forecasters expect the rate to stabilize, others warn it could push back above 7% in the first half of 2026. And risk 4. Trade uncertainty isn't over. This summer, the CUSMA trade deal enters renegotiations. That's the agreement protecting most of our exports to the US. If those talks go badly, or if the new tariffs get layered on top of the existing ones, sectors like autos, lumber, steel, and aluminum could take a direct hit. And those are real jobs in real communities. So here's the honest answer to the question in the title of this video. Is Canada heading for a recession in 2026? Well, according to RSM Canada, overall GDP growth is expected to come in around 1.4% this year. And according to Vanguard, it won't be a boom. But it likely won't be a collapse either. The base case for most major forecasters is that it's going to be slow growth, persistent pain, but not a technical recession, which is officially defined as 2 consecutive quarters of negative GDP. But here's what matters more than the headline numbers. A recession might not be official, but it can feel like one to millions of Canadians. When your rent goes up, your mortgage payment rises, your grocery bills don't come down, and your job feels like a little less secure. That is a recession in your household, whether Statistics Canada call it one or not. And Canada is highly fragmented right now. Alberta, with its energy revenues, is in a different economic reality than Ontario, which is facing the brunt of manufacturing tariffs. Atlantic Canada is more insulated, and Quebec is underperforming. This isn't one economy, it's several, and which one you're living in matters enormously. Okay, enough macroeconomics. Let's talk about you. Whether a recession hits officially or not, the smart move is to prepare like one is coming. Here's what that actually looks like for you. 1. Build or protect your emergency fund. Financial planners recommend 3 to 6 months of expenses. In this environment, lean towards 6 if you're in tariff-sensitive industry, manufacturing, forestry, auto, anything like that. Think about extending that further. 2. Review your mortgage situation now. If you're renewing in 2026, don't wait until the bank mails you a renewal slip. Start talking to a mortgage broker today. Even a quarter point difference in rate or switching from variable to fixed could save you thousands of dollars. 3. Don't panic on investments, but do rebalance. Recession fears often cause people to pull out of markets at exactly the wrong time. If you're invested for the long term, stay the course. But if you're heavily concentrated in rate-sensitive sectors like real estate or heavily leveraged companies, it's worth reviewing with an advisor. 4. Think about income diversification. If your entire household income comes from one source, especially in a trade-exposed sector, now is a good time to think about side income, upskilling, or expanding your professional network. Job losses are a very real thing. 5. Watch the CUSMA negotiations. Seriously, this summer's trade talks could reshape Canada's economic outlook for years. Stay informed, and if you're a business owner in a heavily export sector, have a contingency plan. Here's the bottom line. Canada is not in free fall, but the economy is walking a tightrope, and a lot of Canadians are doing the same. The people who come out ahead in an economic slowdown aren't the ones who predicted it. They're the ones who prepared before its arrival. If this video helped you understand what's exactly happening, hit that like button. It genuinely helps this channel reach more Canadians who need this information. And if you want more breakdowns like this, subscribe. We cover the economic stories that actually affect your wallet. Stay safe, stay informed, and I'll see you in the next one.